I want to bring in our guest host for this hour. He's David Kelly. He's the chief equity strategist at JPMorgan Funds. Of course, Dom here is with me as well. And before, of course, we get to that NYSE Nasdaq situation that broke this morning, David, give me your take on the IMF and Strauss-Kahn.
Yeah, obviously this is a very troubling story. I mean, apart from everything else, I think the fact that he was renting a hotel room with $3,000 a night.
I thought that was incredible.
I mean, even in New York, I mean, these are the guys who are imposing austerity measures on countries all over the world. I think it's
a non-government organization.
I know,
as well,
it's a little over the top. The IMF as an institution has some very important work to do, and I suspect that as an institution it will do that work. But this is obviously a very troubling story.
I mean, also the dynamic here with the whole idea that we could see a non-American or a non-European head or heads at the IMF. Also, all these emerging markets making their case that they should have somebody at the head there. Do you think that's going to happen?
Well, possibly. I mean, I think the problem is this happens at a very bad time for the IMF. They can't really lose momentum, and so whatever they do, this is not a good time for revolution at the IMF. They've got to find out how they can, as an institution, move forward with the least disruption possible.
Right. It's bad for the IMF, but it's even worse, really, for the countries that need the IMF. And we're talking about Greece, we're talking about Portugal.
Well, possibly. But I just think, as an institution, the IMF will find a way to move forward, and even with their head in so much trouble, I think they'll find a way of moving forward here.
Talking about trouble, or I guess avoiding trouble, perhaps, and Nasdaq and ICE saying that they're going to withdraw this bid.
Well, this has been a developing saga for such a long time, guys, and this idea that the regulatory approval was going to be a huge part of it obviously played out this time around. There were concerns on both sides, even with the Bursa bid, but this one obviously came to a head, and that regulators at the Department of Justice saying that we can't have this, you guys cannot do this, and Bob Greifeld kind of saying, all right, we got to take our bow.
What goes through your mind when you read these headlines like this?
Well, I mean, I like the idea of American ownership of the NYSE as an American or as an American citizen. But apart from that, though, I don't think it really changes the big picture. I mean, we've got all these stories going on. But the bottom line is the global economy continues to grow, the American economy continues to grow. As an investor, then the most important thing is not getting distracted. It's really important not to get distracted by these stories and recognize that if the global economy continues to grow, if the U.S. economy continues to grow, then it's time to be a little overweight equities, a little underweight fixed income still.
But can we draw, I mean, to get back to this particular deal, I mean, can we draw any conclusions, though, from the fact that after the Nasdaq and ICE, after they talked to the regulators, they realized that they weren't going to get that through, can we draw anything from that upon what that might affect, how that might affect other M&A transactions?
Well, each industry is evolving, and all of these industries, particularly from a technological perspective, are evolving very quickly. So I don't know that we can draw any hard and fast conclusions about what this means for any other industry. I mean, it's clearly a tough stance. In terms of M&A and activity, Debbie, but I don't know how it translates into.
Let's talk about the bottom line here, guys. Look at the stock of NYSE Euronext right now. It is down about 10-11% here. People expecting that bid. So obviously a huge dynamic here in the way that the market perceives what's going to happen here with these cross-border deals.
Right. Although there's a story out though today, I think you read in the FT about how a lot of companies are obviously holding a lot of foreign cash. That maybe that's going to fuel some more of these cross-border deals.
Well, yeah, I mean, from a U.S. perspective, it would be better to get more of this money back into the United States, but assuming no change in tax laws, then, yeah, I think there will be more international M&A.
David, what do you think is going on in the bond markets?
Well, I think the bond market doesn't believe that we will allow us bump into this debt ceiling. So they believe there's some resolution. But the whole thing troubles me terribly, because this is the financial equivalent of a doomsday machine. You simply, Tim Geithner is completely right about this. You cannot allow us default. You cannot, and why we sort of recklessly threaten default, all it can do is harm us in the long run. And the thing that I object to the most about it is the American public is not being told this. The American public thinks that it is okay to think about. In fact, opinion polls say, most people say we shouldn't raise the debt ceiling. That's craziness.
But I mean, the bond markets are right, though, right, David? I mean,
at the moment they are, but I worry about the long-term consequences of having a political structure in this country which simply doesn't talk about reality at all.
Well, David, they also threw up a great chart there of what they call the 10-year break-even rate, which is what people's expectations are for inflation. And Scarlett made a great point. Inflation expectations are coming down. Is there even any justification for this idea that runaway inflation somewhere in the offing?
No, I don't think there is any real risk of runaway inflation. I think until it's a very competitive global economy. We've still got 9% unemployment in this country. until you have a tighter labor market, you're not going to have an inflation problem. But the real issue is not the inflation issue. The issue is the credit rating of the United States, and we're already building up a lot of debt. And if on top of that we have the charade of irresponsible politicians saying, "Oh, if you don't give me what I want, I'm not going to raise the debt ceiling." I mean that can only damage the Treasury market in the long run.
But to what extent do you think the markets are going to actually send that message to lawmakers? Listen, get this done sooner rather than later. I mean, lawmakers say, "Hey, listen, we can wait till August 2nd. Maybe after that." Markets are telling us we don't have to wait.
I think the market is maybe saying this right now, but let's see where we are in August. I mean, at some stage, this thing could get pushed down to the wire, and it worries me because right at the last minute, if people are using this to try and leverage some more concessions, it's not out of the question that something could go wrong in this.
It is a good point, though, Peter. I mean, is there a sense in some ways that lawmakers are taking their time because, the yields aren't going up, to 6-7%?
No, without a doubt. They see the same polls you indicated, showing that the American people don't want them to raise the debt ceiling. They don't want to vote for this, many Republicans and Democrats.
But let me be clear about this. The reason you have to raise the debt ceiling is because if you don't raise the debt ceiling, then you've got to get spending and taxes at the same level. Now, right now, we're running a deficit of 9% of GDP. If you go from 9% to 0, you will cause a Great Depression. I'm not kidding. I mean, you cannot do this. You cannot actually balance the budget from a 9% deficit to 0 right off the bat.
And this is where we get Geithner talking about the risk of a double-dip recession.
Right.
Yeah.
And Bernanke as well, and to some extent, they've been tuned out thus far in the debate.
And
Today may change
the American
that.
public needs to hear that.
David, and Christina's been following a lot of these deals and breaking a lot of stories on these private equity companies that have been coming in and making deals. Should they be more active given what's, given the markets, given interest rates, the economy?
Well, yeah, because we've got two things going on here. We've got stocks in general are very cheap worldwide, and we've also got a lot of liquidity. And if individual investors don't have the nerve to pay up in terms of in the public markets, it makes perfect sense for private equity companies organizations to come in and try and take advantage of companies with good cash flow at a time when it's very cheap to borrow money.
And this is exactly the case in this?
Yeah, in this particular case, there are businesses within Tyco's overall corporate structure that are very attractive to private equity because they don't have to compete with strategics. For example, the flow control business, which makes industrial valves that industries like the oil refinery business uses to control oil refinery. I mean, that business, several analysts have cited as not attractive for some strategics, for whatever reason it is. So private equity sees an advantage in that. It doesn't have to compete with strategics. Its whole play is to pay less than everybody else. So that's where
you basically buy the cash flow of all these great corporations at a discount because of the way public equity markets are trading.
Is there also some sense, David, that the low interest rate environment is also driving these deals?
Sure, I think part of it's low because part of it is that corporations can borrow at very low corporate interest rates, but also there's this huge pileup in corporate profits. We think that this year we will see an all-time high in terms of quarterly corporate profits or operating earnings, the S&P 500, and that there's been this V-shaped recovery in profits worldwide. We haven't had a V-shaped recovery in the economy, but profits are doing very well, and that is giving companies the ability to do this.
Yeah, I mean, the flip side of the interest rates going so low, making deals more possible, is that it's actually driving prices for deals higher because you can afford to pay more if you can borrow more. So the seller's expectations tend to rise.
Yeah, they're very aggressive, in fact, right?
Yeah, exactly. They're holding out for prices that factor in a very robust recovery, which we really haven't seen yet.
And we were talking last week that might be what's driving some of the hostile takeovers.
Exactly.
Because these sellers are saying, pay us more. Cristina, thank you for bringing us that story.